Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kessling, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everyone, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, Gabelli Portfolio Manager John Belton. Gabelli is a globally diversified, research-driven financial services firm with extensive investment offerings. On the show, we discuss which segment of the AI value chain faces the best prospects, whether large language models face the risk of commoditization, if AI will kill software and SaaS companies, whether we should be concerned about valuations within AI, and more. So here's our show on Is AI a Bubble with Gabelli Portfolio Manager John Belton. John, welcome to the Absolute Return Podcast. How are you doing today?
Julian, nice to be with you virtually. I'm doing well. Thank you.
Yeah, it looks beautiful out there, Westchester at Gabelli headquarters. Now, when talking with professional investors and portfolio managers, I'm always first interested in hearing the formative stages of their career and what initially got them into being interested in investing as a profession and the specific style of investing that really resonated with them. Now, John, growth investor, so super exciting these days. I was wondering what lessons from early on in your career, or it could be in your life, that got you interested in and resonated with growth style investing, and what shaped you to be the professional investor that you are today?
Yeah, well, I actually would say most of my earlier part of my career, I had more exposure to value investing. So I went to Columbia Business School, where value investing is a big focus as the alma mater of Warren Buffett and the home of the value investing program. And then I started my career as a sell-side analyst covering what was certainly then and even more definitely now a more traditional value sector. I was covering media and telecom. And I would just say that at both places, I never really thought of, I always thought kind of the difference between value and growth was somewhat arbitrary. And what I was really drawn to was fundamental investing, and there was always certain types of companies that I was drawn to. And I think those types of companies tended to skew more and more, growth type of companies. And so my first stop on the buy side was at a long short fund called Absoluto Partners. I would consider that sort of a tiger cub style, directionally long, heavy focus on quality, more focus on growth, but really deep fundamental research was the backbone of our strategy. And so I'd say that's where I really started to get more and more exposure to owning growth companies and more traditional growth style investing.
Now, growth investing is really the topic du jour in the markets these days. You've just seen it with tremendous outperformance of NASDAQ securities. AI is a theme that has really just taken over. You look at the Magnificent Seven, large portion of the S&P 500 these days. So certainly artificial intelligence is the most dominant theme in investing for growth investors over the past couple of years. Now, with that, I wanted to talk about this AI boom and how you think about it in terms of stock picking. What segments of that market, whether they be chips or data centers or software companies, what segment of the AI theme do you find most compelling right now? What are the biggest beneficiaries?
Well, first I can discuss sort of at a high level how I think about the AI value chain and the opportunities that are out there. And I think the value chain, I think about it broadly as consisting of three layers. You have the computing equipment layer at the bottom, so chips, servers, networking equipment, really the micro layer of artificial intelligence technology. At the middle layer, I think you have all the different companies that come together to create the physical infrastructure for AI computing equipment. So data center companies, industrial companies providing cooling equipment, cloud computing companies providing data center services, et cetera. And then at the top layer, you have application companies that are building useful products and services with AI technology. And so taking those one by one, I think we're at a point in time where that chip layer, it's got to become obvious who the winners are there. You've got basically a far and ahead leader in NVIDIA, I would say, strong number two in Broadcom, and then a couple companies sort of jockeying to pick off, part of that AI accelerator market. I still think at the chip layer, those leaders still have a lot of growth ahead of them, NVIDIA included. I still think those are decent investments. There have been some catch-up trades more recently in pockets of specifically memory and storage and those types of companies. But by and large, I still feel pretty good about owning the leaders at the chip layer. At the middle layer, that kind of data center layer, I think that we're still somewhat early in the build out. Those products, whether we have some plays, electrical equipment and cooling equipment, and then I think the hyperscale cloud infrastructure as a service platforms are also good plays there. But I think we're sort of in the middle innings there of the data center build out, and I think there's still clearly room to run. But that's the runway is gonna depend on success at the application layer, that third layer, and are there going to be more and more use cases for AI? Are there going to be more and more products created? Is there going to be more and more monetization? I think that remains earliest, but like any tech cycle, the picks and shovels are always the earliest beneficiaries, but they're seldom the biggest beneficiaries. So we're definitely spending a lot of time these days looking for the next killer applications, the next platform companies built on the AI tech stack.
Now, I did want to drill down on the compute segment of the AI market. And of course, NVIDIA, absolute dominant, something like 95% market share. And with that, huge revenue growth, massive margins as well. As such, it's the largest publicly traded company in the world in a market cap approximately $5 trillion. Now, to timestamp this, because this industry is just moving so fast, we're in the first half of January 2026, and some big news over the past month or so was the release of Google's Gemini 3. And what was notable with respect to that large language model is its training on Google's custom TPU chips, which is a new dynamic. And I was wondering what you think of these sort of up-and-comers, whether it's custom chips from some of the hyperscalers, obviously Google most successful there. I know Amazon may be behind, but they have an initiative and tons of resources. And then you have the up-and-comers like AMD. Do any of these serve as a threat to what looks like NVIDIA's unstoppable moat here?
Yeah, great question. Very topical. So a couple things before I get right to the answer. But the first thing I'd say is Google Gemini. Yes, it was allegedly largely trained on TPUs, but what was also clear coming from the advances in that model is, according to the company, the advancements were broadly achieved by deploying more computing resources towards model training. So the quote unquote scaling laws are which NVIDIA and the other chip companies are really paying attention to and are very much intact, meaning, at very simplistically, more compute is still leading to better model performance. So that's a very important takeaway for the chip industry as a whole. And I think that points to still a lot of growth in this addressable market. Now, the other questions you asked pertain more to, I think, so that's a dynamic about the size of the market and the growth in the market. The other questions you asked pertain more to market share. And so, yes, NVIDIA, the leader right now, Broadcom, a number two, AMD kind of jockeying along with maybe Intel as a number 3 and 4 player. So the first thing on Broadcom, the TPU program, that's a little over 10 years old. It's in its 7th generation. This is hardly an upstart. This is a program that a very well capitalized company in Broadcom, about $1.7 trillion market cap there, has deployed significant resources towards developing alongside Google for the better part of a decade. And really what they're trying to do, it's not the same as what NVIDIA does. I think they're going after a small group of very large customers that have the engineering resources to build a custom program. And the fact is, virtually every custom silicon program, especially in AI, that has ever been attempted has failed. TPU is really the exception. You referenced Amazon's Trainium program, that there's some promise there, but most of these programs do fail. And I think it just goes to show that what NVIDIA has done, the ecosystem they've created, the products they've built out, very, very difficult to replicate. Now, I think in the future, I do think for these large tech companies, for these large platforms, so thinking about the hyperscale cloud companies, Microsoft, Google, Meta, Amazon, it will make sense to have custom silicon programs to optimize basically the cost of computing and to basically take certain workloads or certain applications and run them on custom designed infrastructure. So in some cases, there could be a performance benefit as well. But the rest of the market, the enterprises, the companies that don't have the same sorts of engineering know-how, resources, will always be best off on NVIDIA. And the big reason for that is the CUDA library that NVIDIA has built up over the last 20 years. You've got something like 4 million developers that have been trained in CUDA, which is compatible with NVIDIA infrastructure. So looking forward, I think NVIDIA is going to continue to command a large share of the market, the largest share of the market, the share of the market where there's the most margin potential, the most pricing power. And then, there's going to be a subset of the market that will diversify away from NVIDIA, and whether that's with Broadcom and or AMD remains to be seen. The only other point I'd make is, at the end of the day, who are Broadcom and AMD competing with? They're actually, I think, their toughest competitor is the earlier generation of NVIDIA chips. And so if Broadcom, AMD, if those types of companies are trying to enter the market as a lower cost provider, earlier versions or generations of NVIDIA chips are going to be still a very stiff competition.
That's interesting. Now, another dynamic that I think is highly uncertain, at least in my opinion, and trying to gauge what other investors think about it as the industry moves from focused on training to more so be focused on inference. And if that is a threat to NVIDIA's lead, if other chips can be more inference focused, as I understand it. One of the main drivers of NVIDIA's recently announced acquisition of Grok, licensing and acqui-hire, just so we don't start any trust issues, is that this Grok technology was perhaps better and more competitive than NVIDIA on straight inference. So do you think that, as that plays out over time, is that a potential threat to NVIDIA's market share?
I'll preface this by saying I'm still doing work on this part of the technology, so not quite an expert in it yet, but it does seem like the inference workload is sort of splitting into two different types of inferencing, prefill and decode. And I think that is something that Grok has built some pretty interesting technology around that NVIDIA is clearly interested in. But in terms of the training versus inference, the market has been majority inference now for a while. And I think, the training, a lot of the generative AI workloads and specifically on large language model development, that's where the training has been. But AI is a much bigger market than that. And, some of the earliest really large scale commercial use cases for AI, specifically around digital media, digital advertising, e-commerce, those have been big inference markets for several years, and NVIDIA has maintained, really a monopoly in those use cases to date as well.
Now, moving to the second layer, the infrastructure layer, this may be where the biggest bull versus bear debate exists with respect to data centers and the so-called neoclouds, the firms buying as many chips as possible, putting them in these big buildings and, running perhaps 100,000 or more GPU clusters, which are just incredible marvels of modern technology. But, who knows what they'll look like in 20 years or so. Now, there's several questions and debates happening. Number one is, is there any sort of competitive advantage in a data center or a neocloud? Are they depreciating these GPUs at an appropriate rate? Is it 6 years? Is it 3 years? Is it less? Do they become obsolete? Do they physically depreciate? If they're being overclocked or overused for AI slop videos, does that affect it? And then, is there how much of this is speculative capacity being built out? And finally, like all of the hurdles and roadblocks, getting power, getting electricians to build these things. There's like so many questions with respect to the infrastructure layer. How do you view kind of the bull-bear debate, and where do you view as the biggest risks there?
Right. A lot of questions there. So let's see if I can remember all of them. But
yeah, you don't have to touch on all those. Those are just kind of some of the questions that I constantly hear from investors. So whatever you think is most interesting.
So I mean, I think a lot of those questions are leading to the overarching question of is being a data center provider for AI infrastructure a good business?
Yes.
And my view is that there's some similarities obviously to public cloud, and we've learned a lot about the public cloud infrastructure as a service business model over the last several years. And I think it would have been very easy to say 10 years ago that the business of building a data center, filling it with servers, creating some virtualization software and leasing those servers was a commodity. But here we are 10 years later, and that just has not really proven to be the case. You've got Amazon, Microsoft, and Google. Amazon's AWS division has operating margins in the mid to high 30s, still growing revenue 20+% at $100 billion plus revenue scale. That doesn't sound like a commodity business to me. And similar with Azure and Google Cloud. So, I think what the key for the public cloud businesses has been, you land customers with the infrastructure, and then you upsell with kind of value-added services. And then on the back end, you do some things on the cost side to drive margins, whether that's leverage your scale or optimize sort of the delivery of the platform. And I think a lot of that is going to continue to be the case in the AI world as well. And so what do you need to succeed in this business? I think you need a very deep and fragmented plus loyal base of customers. You need a lot of scale, and you need the technical ability to create efficiencies and improve profitability that doesn't come at the expense of your customers. And so I think a lot of that is going to continue to be possible. And I think we've seen plenty of early signs from those big three cloud providers, plus I would say Oracle as well, so far that these are looking like decent businesses. So the other question you asked was around the depreciation schedule that a lot of these providers are using. And I think there's been some skeptics in the market that have suggested that the depreciation schedule is too long. And in reality, is this computing equipment depreciates faster. And I think the industry standard is something like a 5 to 6 year useful life on AI computing equipment. And my view is there's just no evidence that that's been the case in the real world in the market. I think these every generation of GPU to date has been fully sold out, and every generation of GPU to date is still creating economic value beyond that stated useful life. So we do have generations of GPUs that are more than 6 years old that are still running at full uptime. So, time will tell. I do think part of the argument is around not just the length of the depreciation schedule, but maybe should these assets be depreciated on an accelerated schedule versus straight lined. And yeah, there could be an argument there, but I think by that point we're pretty deep in the weeds. So bottom line is, I do think providing data center services for AI infrastructure is a decent business. I feel much better about the incumbent cloud companies, feel better about their scale, their engineering expertise. And I'm a little bit more skeptical, relatively speaking, of the neo clouds, who I think are really outsized beneficiaries in this current environment where where supply and demand are not in balance.
And do you think there's a major risk in just some of the supply chain there, whether it's getting the power? Like that seems to be a big issue, or cooling systems. I heard just getting the turbines to generate power for some of these data centers is like a multi-year wait.
Yeah, we own GE Vernova, which is a big beneficiary of that as one of the two global manufacturers of natural gas turbines. And their business is basically sold out through the end of the decade. But, what's interesting, I think the high level point, there's no shortage of bottlenecks, whether it's access to power or access to labor is a big one, access to land, networking equipment, et cetera. But what I think is healthy about this whole dynamic is it puts a sort of a natural governor on the pace of expansion that the industry is able to progress at. And I do think, given this is still, for many use cases, unproven technology, and given that there is some investment here that's going ahead of monetization or ahead of a business, just the idea that there's sort of a natural governor on the pace of expansion, I think, is healthy. I think it without these bottlenecks, the investment cycle would have grown much, much faster, and it's unclear if that would have been a healthy thing.
Right. Now, to touch on the third layer, the application layer, a lot of unknowns and debates happening there. The first one that I wanted to discuss was whether or not you think large language models are facing the risk of commoditization. We saw some concern in the market just over a year ago when one of DeepSeek's advanced models came out. And then I heard recent comments of the past month or so from Salesforce's Mark Benioff saying, oh, these LLMs are commoditized. We just go with the low-cost version. So what are your thoughts on the competitive dynamics within LLMs?
Well, I do think LLMs, it's somewhat clear that LLMs commoditize quickly, but I don't think that doesn't mean they can't be very good businesses. And I think this is a market where, at least in the West, there seem to be something like 4 companies really separating themselves from the pack: OpenAI, Anthropic, xAI, and Google or Gemini. And again, I'd probably liken this a little bit to the public cloud model, where the actual service that is being provided can be quickly replicated technically, but it's a sticky customer base. A lot of applications and businesses are building on top of these models. And so there's a switching cost associated with that. And then the model companies themselves, I think one really interesting thing that in the latest version of OpenAI's GPT, I think it was GPT 4.5 that came out a few months back, there weren't so much leaps in model performance, but what there were leaps in was the way that the model architecture and the way the model routes queries, and in doing so optimizes costs. And so I think the financials that have been discussed in the public for OpenAI show they've got really quickly expanding margins. And I do think there's going to be kind of a secret sauce that these model companies have on the back end to run these businesses profitably. And I do think there's going to be a moat there. So I guess the bottom line is, yeah, in a vacuum, in isolation, I can agree with the idea that models are quickly commoditized, but that doesn't mean that these aren't going to be very good businesses. Doesn't mean that these aren't already good businesses. And one thing I've been noticing over the last couple of months, just as a final point, the number of partnerships that are being announced with these model companies, and you've got Eli Lilly, a deal with OpenAI. You've got Intuit, a deal with OpenAI, and you can go across so many different industries. And C.H. Robinson is a transportation company with OpenAI, and it's become very clear that these model API pull businesses are going to have a very broad customer base, and I think can be really a toll booth for knowledge work across many different industries.
One key question, and you mentioned the four big players within LLMs, of which one is tremendously profitable with an exceptional amount of resources. So you have Google versus these upstarts, Anthropic, XAI, and OpenAI. And OpenAI is a unique position in that they have the distribution, massive user base, first mover advantage. I have heard a thesis that if Google wanted to, it could just try to run at basically zero gross margin and put the others out of business. Do you think that there's any validity to the competitive strength of Google as sort of dominating the LLM side? And secondly, was that sort of showcased with the recently announced deal with Apple? Like, does that provide such a competitive threat that it's perhaps existential from some of the smaller, although leading model players?
Yeah, I mean, it's good questions. And I don't have access to all the financials of the private companies, but I do think that Google's capitalization, Google's balance sheet, Google's free cash flow is an advantage, all else equal, over the private competitors, which are burning cash, which are seemingly going to raise more capital every couple of months, it seems like. But at the same time, Google is a public company. Google has public shareholders. Why do Google shareholders own Google stock? Maybe Gemini is part of the reason, but it's certainly not the whole reason. And Google there are governors on Google, and the market is going to prevent Google from spending too aggressively on this technology as well. So I think there are offsets to that dynamic where, yes, Google has a stronger balance sheet, has existing free cash flow and other business lines to pull from to invest in building out AI technology, but Google has shareholders in a way that these private companies in a different way.
That's a good point. Now, another competitive threat, just from a more broader perspective, and we've seen this thesis play out over the past several months in the market, is thesis that AI and vibe coding will kill software and SaaS businesses. Do you think that's a valid thesis? And what are your thoughts on the future for SaaS companies?
I generally hesitate to quickly call for the demise of a big industry that's had so much consistent growth until now. But for sure, AI is a clear threat to many application software companies. I think, at best, AI is causing a lot of these companies to pivot their business models in ways which are A, more capital intensive, and B, which are shifting towards somewhat lower revenue quality. So I think a lot of these software companies, historically, why have investors loved application software? It's beyond high growth. It's very high margins, and it's very repeatable or consistent subscription-based revenues. And what AI has caused a lot of these companies to do is A, ramp up investment, so take down margins, and B, shift to more kind of usage-based or consumption-based revenues. And I think there's some risk associated with that. So, I mean, I think that is something that's already happened. That is clear. That's a net negative for these companies. And then at worst, I think some of what you're alluding to is, maybe vibe coding does reduce the barriers a little bit in this industry. Maybe it does make it easier for competitors to enter the market, and maybe it does introduce new competition for these companies. I kind of come back to companies that have very loyal customer bases, that I sort of feel like vertical software is a little bit better positioned than horizontal software here. But companies with loyal customer bases have the right to win with AI. They have the right to distribute, AI or agentic software to their customer bases. And the only other point I make from like a public equities standpoint is a lot of these stocks, a lot of these companies there's a starting point of very high valuations that have now come back down to earth. So I think that's been a big part of this move as well. There's been sort of a bit of a valuation unwind that took many years to get to where it got to, and that's been taking place on the downside as well.
Now, to put a bow on the AI discussion, there's one primary question that is the most interesting to investors, and that's, in your opinion, is AI in a bubble?
I think this question it's just way too simple of a question for the nuances of the market. But maybe the way I like to think about this is historically in the stock market, I think there have been sort of two types of bubbles. There have been valuation bubbles, and there have been earnings bubbles or investment bubbles. And valuation bubbles, self-explanatory. A security or the market gets way overextended at a valuation that doesn't, that gets detached from fundamentals, and then that valuation comes crashing down to earth. Earnings or investment bubbles, company or the market's earnings get way overextended because of an investment cycle and then come crashing down to earth. And I think a lot of people compare this current AI landscape to the dot-com bubble. And one very clear difference I see is it's always easier to talk about this in retrospect, but in retrospect, the dot-com bubble was both a valuation bubble and an earnings bubble. If you took the magnificent seven of the day, the seven largest tech companies at the end of 1999, they're trading at a median forward price earnings multiple of about 90 times.
Wow.
You take the seven largest tech companies today, median forward price earnings multiple is 25 times. So those two things are definitely objectively not comparable. Now, are we in an earnings bubble? Because in 1999, we were also in an earnings bubble where there was a massive amount of investment that was going ahead of revenue, and then the music stopped. And I think it's obviously very hard to say, but a couple differences I see today, and I'll preface this by saying I understand the most dangerous words in investing are this time is different, but there are a couple differences here. So one, the companies that are making the investments this time around are extremely well capitalized, still have free cash flow, limited to no debt by and large, and more importantly, are using AI in their existing businesses and have been successfully using AI to take market share or expand margins. So that's the digital advertising companies, the e-commerce companies, the cloud computing companies, and in Tesla's case, the autonomous driving companies. So that's a difference. And then B, I think the replacement cycle associated with a lot of infrastructure is much shorter than the replacement cycle associated with the infrastructure investment cycle of the 90s. So in the 90s, the investment was going towards fiber and telecom equipment and equipment that's still in the ground and operational today, 26 years later, 25 years later. Whereas a lot of this AI investment is going towards computing equipment that is going to need to be replaced in maybe if it's 5 years, 3 years, 7 years, whatever it is. But I think that makes for a smoother cycle. So stepping back, my view is we are not in a valuation bubble. I do get worried about what's going to happen on the other side of this cycle, because this definitely will be a cycle. But I feel pretty good for a lot of the reasons I just discussed, and don't think this cycle's ending anytime in the next, call it 12 to 18 months at least.
Yeah, and it's taken a lot of the other computing companies with it, whether it's like Dell or SanDisk was like the best performing stock in the S&P 500. So there's a big sort of investment capex, whether it's a bubble or not. There could be many, many victims of it if and when it turns. So that's something certainly investors need to pay close attention to. Now, John, prior to letting you go, one last question. Outside of AI, what is your top emerging growth theme for 2026?
Oh, I have to choose just one, and it can't be AI. Oh, man, that's tough.
Kind of like think about AI, but 3 years ago.
Yeah. Well, I guess I just think this idea of it's really less so a technology theme, but I think what's clearly been happening in the market over the last the U.S. market, that is, over the last 3-6 months or so, is this excitement about economic reacceleration. And I think there's this view that, and I think AI is driving some of the productivity behind that, but there's this view that we are coming out of a period where we've been stumbled because of the government shutdown. We've had this period of uncertainty around tariffs that we're coming out of. We've got fiscal stimulus coming this year in the form of the big beautiful bill, and I think that should spark a nice inflection in non-AI type of capex. And so I think we're sort of entering this little growth acceleration uptick, and I think that's just causing a lot of areas outside of tech to become investable again for growth investors. So I think what I'm excited about is hopefully being able to look at and invest in more companies that aren't tied so tightly to AI, because I think that AI has just been such a dominant theme over the last couple of years.
Yep, and it'll be incredible to watch some of the use cases, particularly in robotics. I think that's one that interests me. Nonetheless, John, thanks for coming on the show today, contributing your insights into the great AI bubble debate, which for now is unresolved, but it'll be fascinating to watch it play out. So wish you the best of luck, and thanks for coming on the show.
Thank you very much. Nice to be with you, Julian.
All right. Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.
John Belton is the portfolio manager for Gabelli Growth Fund, the Gabelli Global Growth Fund, and the Gabelli Growth Innovators ETF. GAMCO is providing these links as a matter of general information. We do not intend for these links to be complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of September 30th, 2025, affiliates of GAMCO Investors, Inc. beneficially own less than 1% of all companies mentioned. Shares of this ETF are bought and sold at market price, not NAV, and are not individually redeemed from the fund. Buying or selling ETF shares may require additional fees such as brokerage commissions, which will reduce returns. These additional risks may be even greater in challenging or uncertain market conditions. Returns represent past performance and do not guarantee future results due to market volatility. Current performance may be lower or higher than the performance data quoted. Investment return and principal value will fluctuate, so upon redemption, shares may be worth more or less than their original cost. To obtain the most recent month-end performance information and a prospectus, please call 1-800-GABELLI or visit www.gabelli.com. You should consider the ETF's investment objectives, risks, charges, and expenses carefully before you invest. The ETF's prospectus is available from G.Distributors, LLC, a registered broker-dealer and FINRA member firm, and contains this and other information about the ETFs and should be read carefully before investing. To obtain a prospectus, please call 888-GABELLI or visit www.gabelli.com. Distributed by G.Distributors, LLC, a registered broker-dealer and FINRA member firm.